In 1875, an Ohio farmer named Samuel Benner lost his fortune in a market panic. He spent the aftermath tracking the prices of corn, hogs, and pig iron, matching economic cycles to agricultural and solar rhythms to create a 150-year market forecasting tool. Benner's cycle mapped extreme volatility and panic years with a high degree of precision. This animated overlay shows the historical Benner cycle rhythm charting against the S&P 500. The model accurately intersects with the severe crashes of 1929 and 2008. The chart categorizes market years into specific action phases. As we approach 2026, the cycle points to a major good times peak, a designated moment to unload assets before a multi-year slope downward. Applying a purely historical, psychology-based model carries severe risks today. The global economy is undergoing a systemic industrial realignment. Long-term asset valuation in the modern era is dictated by severe physical hardware constraints, overriding the cyclical psychology of the past century. To track global physical expansion, we can look past historical charts and examine real-time import and export customs data. This chart tracks Korean monthly semiconductor export values over the past 2 years. Because South Korea houses Samsung and SK Hynix, their export data represents the bedrock of global memory production. Looking closely at the year-over-year percentage growth trend line, we see a positive divergence from the historical average. The volume is following an accelerating, exponential upward curve. The limiting factor on this growth is the physical ceiling of the manufacturing supply chain itself, not a lack of market demand. Institutional investors looking to time the market must track the specific engineering choke points gating the artificial intelligence supercycle. The internal logic of the Benner model rests on a 3-row categorization structure, grouping market years by prevailing sentiment. Benner's 10-year action plan highlights good times, periods of extreme optimism. For 2026, the instruction is sell and unload stocks. Following that peak, a multi-year cooling period shifts the directive to preserving capital, leading to a 2032 hard times accumulation point, the designated time to buy. This structure operates as a macro map for managing overall portfolio exposure. It dictates when to be aggressive and when to move into cash, rather than acting as a surgical day-to-day trading tool. The Benner cycle successfully maps normalized human behavior. It does not account for a global economy restricted by an acute shortage of human engineering capital. Modern artificial intelligence compute requires a rapid expansion of physical logic gates, increasing the complexity of semiconductor design at a pace that far exceeds historic norms. This graph charts the intersection of rising transistor counts against qualified engineers. Notice the descending orange line representing U.S. electrical engineering degrees awarded. The talent pipeline is shrinking. Contrast that against the aggressively ascending green line of Apple's transistor counts scaling sharply upward. Relying entirely on manual human engineering carries immense temporal and financial risk. A single respin of an advanced silicon design costs tens of millions of dollars and pushes high-volume production schedules back by entire quarters. The only viable bridge across this widening productivity gap is the industrialization of electronic design automation, or EDA. Manufacturing a modern artificial intelligence semiconductor demands immense physical precision across dozens of highly specialized, fully automated tools operating in flawless synchrony. Early microprocessors, like the Intel C8080 seen here, were designed using an entirely different scale of human involvement. Engineers originally sketched layouts on graph paper, and technicians manually cut the geometric layers into rubelith film with knives. Physical human labor placed a hard ceiling on supply and complexity. This flowchart illustrates the modern 13-step chip design waterfall, navigating a million-fold increase in design complexity. The critical transition occurs between steps 3 and 7, where human intent, system Verilog code, is converted into a physical geometry via logic synthesis. This is the Synopsys IC Compiler 2 interface, displaying a routing congestion heat map. EDA software actively manages the spatial requirements and power delivery for billions of individual transistors. 3 companies, Synopsys, Cadence, and Siemens, monopolize the software. Without their tools, no chip designed after 1985 would exist. They operate as the strict gatekeepers of the current manufacturing cycle. Recognizing these physical limits requires a shift in how we assess value capture within a constrained supply chain. The AI hardware industry operates as a series of nested bilateral oligopolies. In this structure, the entity with the scarcest capacity and fewest substitutes captures a disproportionate share of the profit. The widest top layer represents GPU and accelerator design. While highly profitable, this layer is the most substitutable. Major cloud providers are aggressively funding in-house custom ASICs, limiting long-term pricing power. Capital flow constricts deeply at TSMC's CoWoS advanced packaging platform. There are 0 scalable alternatives. The flow then moves through another strict choke point, high bandwidth memory, controlled by a 3-3 oligopoly using locked take-or-pay contracts. The market frequently misprices these underlying nodes. Equities tied to advanced packaging and memory are assigned cyclical hardware valuations, discounting the structural pricing power they hold over the entire industry. The economic surplus generated by the current supercycle bypasses consumer-facing software brands and anchors directly into these highly constrained physical infrastructure layers. We can now place the Benner cycle's 2027 psychological downturn directly against the locked-in 15-year supply contracts driving data center expansion. Broad market indices, driven by software and consumer spending, remain highly vulnerable to cyclical corrections. At the exact same time, specific industrial sectors are mandated to expand regardless of broader economic sentiment. These bottlenecks create localized valuation floors. Extreme scarcity in critical hardware components protects infrastructure equities from generalized macroeconomic sell-offs. Replicating the decades of learning curves built into EDA algorithms or the capital expenditures of a leading-edge fabrication plant is nearly impossible for a new entrant. This complexity acts as a permanent defensive moat. The physics of semiconductor manufacturing directly alter the expected behavior of the 2026 market peak, overriding cyclical sentiment. Applying these dual frameworks gives institutional investors a precise mechanism for modern asset allocation. The historical mapping of the Benner cycle remains useful for scaling down broad, passive market exposure as equities approach the high-risk zenith of 2026. However, preserving capital does not mean exiting the market entirely. Investors must reallocate that preserved wealth away from high-multiple, easily replicable software and directly into physical bottlenecks. The fortress assets of this decade are the memory oligopolies, the advanced packaging foundries, and the electronic design automation monopolies. Artificial general intelligence is a physical problem requiring a physical solution. In the 2026 cycle, the most durable returns will be found at the supply chain node.